In order to fast-track growth rates, India needs all engines of its economy firing, from private and government investments to domestic demand and exports. However, only 2 of the 4, government investments and exports, seem to be in the play right now. And even here, the government's ability to drive demand is constrained by higher levels of deficit and debt. While the government investment is constrained by deficit and debt, private investment has been lagging too, and it is showing no signs of a revival. India Inc.'s asset turnover ratio declined to a new low of 0.71 in FY21. Now, if you are wondering what an asset turnover ratio means, it is a company's or industry's revenues relative to the value of its assets. Basically, it is the measure of its capacity utilization. The ratio, which was at a record high of 1.16 in FY06, fell to 0.78 in FY20 and further to 0.71 in FY21. This means Indian companies' capacity utilization across sectors, which had been declining for some time, took a serious hit due to the coronavirus pandemic. Now, if its capacity utilization is at a record low, India Inc.'s ability to kickstart a fresh round of capacity expansion would seem doubtful. Since companies in most sectors are sitting on a lot of spare or idle capacity, they would have little incentive to augment capacity or launch new projects. Analysts do expect an improvement in capacity utilization in FY22, but they also point out that companies go for capacity expansion only when the asset turnover ratio approaches 1. The problem is compounded by the fact that there cannot be a big surge in bank credit till India Inc. starts investing more. And amid all this, there is no relief on the manufacturing front either. The automobile sector accounts for nearly a quarter of all manufacturing output in India. But sales of passenger vehicles in FY21 were at the same level as in FY16, and two-wheeler sales in the domestic market last financial year were the lowest in 7 years. Combined net sales of 682 companies, excluding banks, non-banking financial companies and oil and gas, but including Reliance Industries, were down 7% in FY21 at 46.6 trillion rupees. This was the lowest in 3 years. By comparison, these companies' net profits were up 55% year-on-year, mainly on a low base at 3.38 trillion rupees. So, what is the overall scenario right now? How will India Inc.'s low capacity utilization impact private investment? We spoke to K Bhattacharya for answer to these questions.
The capacity utilization level of all these companies has actually been declining at a fairly rapid pace. For example, if your asset productivity goes down, it essentially means capacity utilization also goes down. And worse, what it means is that the future appetite for fresh investment is also adversely affected. Because if your capacity utilization is low, in other words, if your asset turnover ratio is low, in other words, if for every 100 unit of asset, you have a turnover of only 70, then naturally you will first focus on making your 100 units of asset produce more by way of turnover till you go in for higher assets. So the investment climate does get adversely affected if you have an asset turnover ratio which is as low as 70 units. So these have, I would say, serious implications for investments going forward and also the overall economic growth prospect.
Well, Mr. Bhattacharya's take seems to suggest that it's going to be daunting for companies to kickstart a fresh round of capacity expansion right now. We only hope the demand will sustain and there will be an earlier revival of the capex cycle.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.